Welcome back. We're on day 3 of our tax and asset protection event. My name is Amanda Winalda. I'm an executive attorney here at Anderson Business Advisors. And if you're a high net worth earner, or even if you just want to save on taxes, then stick around for the next 10 minutes because we've got Eric Oliver from Cost Segregation Authority with us. Eric, how are you?
I'm good. Thanks for having me.
All right. Well, why don't we start off? Just give us a little bit of your background and what Cost Segregation Authority does.
Yeah, so my background's in accounting. So my degree's in accounting. Been with Cost Seg Authority for about 7 years now. And we work with tax preparers and investors across the country trying to reduce tax liabilities through cost segregation.
All right, so in order to really understand what Cost Seg does, let's back it up and talk about taxes, passive income, active income. How are we generating these losses?
Yeah, so typically your real estate, when we do our cost segregation study, those deductions or any real estate deduction is typically considered a passive deduction. Now there's some ways to get around that with real estate professional status and a couple different things, but for the most part, those deductions are considered passive deductions, and then your W-2 or your active income is what you do on a daily basis. So for me, for example, I'm a W-2 employee at Cost Seg Authority. That's my active income. I've got my passive real estate on the side. Those are passive deductions and passive income.
Yeah, that always is kind of funny when you're talking to real estate investors because investing in real estate's not really passive.
Right. No, there's a lot of work that goes into it. It's not like you're just doing it on the side and it takes care of itself.
Exactly. So it's an IRS rule that considers it in legal terms per se passive, means automatically passive unless you're doing something that is then making it active.
Right, yeah. So you can become what they call a real estate professional for tax purposes, and that means that you're doing at least 750 hours a week doing, or not a week,
A year.
750 hours a year doing real estate, which is about 14 and a half hours a week. That's the easier test. The harder test is you've got to spend 51% of your working time doing real estate. And so if you're a full-time cost seg employee like I am doing 40 hours a week, I would have to then do 41 hours a week on my real estate business and in order to qualify.
Yeah.
So that's very difficult for a lot of full-time W-2 employees.
Okay, so now that we've established Cost Seg is something to do with real estate, something to do with tax, how exactly does it work?
Yeah, so cost segregation is really just accelerated depreciation on your real estate assets. So normally real estate assets get depreciated either over 39 years for commercial real estate or 27 and a half years for residential. And so what we say, instead of taking 1/39th of a deduction, or roughly 2.5%, what if we can accelerate that and take bigger deductions in the early years? Now, number of reasons why you'd want to do that. You're not going to own the property for 39 years typically. There's cash flow. You want that cash flow now. There's inflation. There's time value of money. So we say, give me my deductions now versus letting the IRS hold on to these for the next 39 years. And so the way we can do that is through an engineering-based study where we come in, identify the short-term assets within your real estate. So things like carpet and countertops, appliances, curbs, gutters, asphalt,
You even
lots.
go out and count the trees and shrubs on
We
the
do,
property.
Yes. Trees, bushes, and shrubs are actually a 15-year asset, so we shouldn't be depreciating them over
Not in my
31.
house. They're like
No?
a 5-week asset.
5 week? You don't have a green thumb?
No, not at all.
So, but yes, so when you buy, let's just use a single-family rental. You buy a single-family rental for $400,000. Well, of that $400,000, maybe there's $25,000 worth of flooring, and there's $8,000 worth of cabinets, and there's $15,000 worth of concrete outside in the driveway. Well, all those things that I mentioned, the IRS says depreciate over a much faster useful life than 27 and a half years. And so we put a value to those, put them in the right bucket per se, which allows your tax preparer to then accelerate those and take those deductions at a faster rate.
So give us an example. So you did a single family residence. What other types of properties can this work for?
Yeah, that's a great question. So any revenue generating property. So we've done everything from single family rentals, basement apartments, storage units, car washes. Car washes is an interesting one. If you think about a car wash, what are you buying when you buy a car wash? You're basically buying land improvements like the landscaping, and you're buying equipment.
Yeah.
And so all that stuff should not be depreciated over a long, useful life. And so sometimes we can create huge deductions on car washes, but really just any revenue generating property. You cannot do it on your primary residence.
Right.
You're not
It's
able
not
to take
business
depreciation on your primary residence, but any revenue generating property that you're taking depreciation on, we should certainly look at to see if we can accelerate those deductions and create that bigger tax savings in the early years.
In terms of the ideal client, does this strategy work for?
It typically works for everybody at some point within the life cycle of a building. So it's not a matter of if you should do cost seg, it's just a matter of when in order to maximize the tax savings. So anybody who's paying tax, anybody who has real estate should at least look into it to identify if it works for them in that specific year or not. But if it doesn't work that year, it might work the following year when you sell an asset and you're trying to offset capital gains. There's a number of different strategies that you can employ when using cost segregation to lower your tax savings. And to be honest, it's one of the few expenses that I'm aware of that you can kind of pick and choose when you use it. So a lot of expenses you have to, if I build a new pool at my apartment complex, I got to expense that in the year that I build the pool. Where cost segregation, you just keep it in your back pocket. If you don't have a high income year, maybe you don't use cost segregation this year. Maybe you wait till next year when you sell an asset and you have a huge capital gain, or when you wait for 5 years when all of a sudden you have no more expenses and all of a sudden these properties are starting to cash flow and you've got all this income. It's one of the few tax tools that I'm aware of in real estate that you can kind of pick and choose when you use it.
That makes it super flexible. So on that timing question, is there a good time to do the study or the best time to do the study, both in terms of like the tax year, the calendar year, and also like when you're getting the property or?
Yeah, that's a great question. So I would always advise we even will run a free analysis before you even purchase the property. So a lot of our clients will call me and say, hey, Eric, I'm looking at 3 different properties. Can you run an analysis on these 3 properties and let me know which one's going to create the biggest deduction? Yeah. So I would say as soon as you identify a property that you potentially could buy, at least get the analysis run. Doesn't mean you have to do it that year. A lot of our clients are high income earners. They're in that highest tax bracket. They're probably always going to be in that highest tax bracket. So they just call us the moment they buy a property and say, hey, I just bought a new property. I got to do it. I need to offset my income at these high tax brackets. And so I would always just advise, the information is it's key. And so just get the information. It doesn't mean you have to do it. You're going to want to get the information from us, consult with your tax preparer. They'll help guide you through whether or not this is a good year. The second part of your question is, as far as timing goes, when you actually have to do the study, the nice thing is you don't actually have to do the study. You need to have the study completed by the time you file your tax returns.
So not by the end of the calendar year.
Not by the end of the calendar year. That's a misconception in our industry. And a lot of, I don't want to call them sleazy cost seg professionals, but a lot of people will tell you that to hurry and get you to sign up because they're like, oh, you better get it done before the end of the year.
Well, not the ones offering free analysis before you even get it done.
Right. So you actually don't need the cost seg study done. You really, if you bought a property in January of 2023 and you want to use the cost seg study for your 2023 tax return, technically you have until next October 15th
if you file that extension.
If you file an extension. So you've got plenty of time to take advantage of these. The studies themselves do take about 30 to 40 days to complete. And so you'll want to make sure you give yourself plenty of time. We do have seasonality in our business. Obviously, we're very busy come February, March, trying to get everything done by April, and then we get busy again September, trying to get everything done.
Yeah, the normal tax season, busy seasons.
So I wouldn't wait too long, but you definitely want to get the numbers run so you can start to make those tax planning decisions.
That's one of the great things, because when I started at Anderson, I did a lot of tax consults and advising, and people will come the last week of December and be like, what can we do? Or even the beginning of when they're filing their taxes and say, what can I do to make my taxes lower? And I'm like, you could have called us 3 months ago. But this is actually one of those strategies that it would still work.
Yeah. A lot of people, they rush at the end of the year and they try and go out and buy a truck or buy a bunch of inventory or something to reduce their tax liability. But this is one of the few things that I'm aware of that you can actually do in 2024 that can still impact your 2023 tax return.
So can you give us an example of sort of the high end of what someone can save? Like throw out some real numbers. I know you don't have any like slides or calculator right now.
But so kind of some real numbers. We'll just take a $1 million asset just because I can do that math easy in my head. So let's say you've got $1 million. Even numbers. You've got $1 million asset. Land is always non-depreciable, so you always have to back out your land value. So let's say you actually bought something for $1.2 million. You take out $200,000 for the land. You've got $1 million of depreciable basis. Well, we typically, on an average study, segregate somewhere around 30 to 35% of those assets into shorter useful life. So of the $1 million, we're going to get $300,000 to $350,000 shifted into shorter asset lives. There's something called bonus that we didn't have time to talk about, but bonus allows you to take. It basically puts cost segregation on steroids. So if we find $350,000, let's do 300 because that math is easy. If we have $300,000 of deduction you actually get to take 80% of that, or 240,000 of that, all in the first year. There's something called bonus depreciation. It was 100% for any assets.
That's going down.
It's going down, yeah. So it was 100% for any assets placed into service between 9/27 of 17 and 12/31 of 2022. So last year, starting this year, it's 80% bonus. Next year, it drops to 60, then 40, and then it finally phases out in 2027 when it's down to 0.
But like any law, Congress can always decide to re-up it.
They can, and there's actually been. I just read an article recently. The Ways and Means Committee in Congress has put forth 2 proposals to extend the 100% bonus through 2025.
Yeah, so that would be great.
So it would be great. So, but if you're getting a $240,000 deduction, so you're taking $240,000 off of your taxable income, and if you're in a, let's call it a 30% conservatively tax bracket, because that's easy math. That's a $72,000 tax savings. And so
that's why you got the accounting degree and I got the law degree.
I can only do whole numbers in my head.
That's still so.
Yeah, 74,000, and a study like that on $1 million asset, depending on the size, it might cost you $4,000 or $5,000, $4,000 probably.
Well worth it
to save $70,000+
Yeah, who wouldn't
taxes.
take that deal any day of the week?
So, big numbers.
So if somebody is wanting to do this, what's the first step, or what sort of documents do they need to have ready when they come to you?
Yeah, so we'll always do, as I mentioned, a free benefit analysis. So the first thing we want to do is get a copy of the closing statement if you bought it this year. So that'll have the address, the purchase price, etc. If you bought it in a prior year, you'll want to get with your tax preparer and then provide us a depreciation schedule, because that depreciation schedule will tell us when you bought it, how much you paid for it. It'll tell us how much depreciation you've already taken on the asset, and then we can run our numbers to figure out what we can bring forward. So, but the first step is to get the analysis, providing either piece of that information.
Yeah. So if you guys are interested, or if you want to get your free consultation with Cost Segregation Authority, go ahead and head over to andersonadvisors.com/CSA, Cost Seg Authority.
Yeah. And we usually turn those around in 24 to 48 hours, and so we'll get you some initial numbers. Take that, share it with your Anderson advisors, your advisor at Anderson, at Anderson, your advisor at Anderson Advisors, yes.
All the advisors.
All the advisors. But share it with Anderson. They'll be able to let you know they'll actually put it into a mock return and figure out what exactly that's going to equate for you, because it is based on your taxable tax bracket. So $1 million or a $300,000 deduction for me is going to save me a different amount than you, because you get paid those big dollars. You're in those high tax brackets.
So they say.
So I'm not in that high tax bracket like you, so it's not going to save me quite as much. But that's why it's important to take the information, give it to your tax preparer, let them look at it, and then they can advise, or we can help advise whether or not it makes sense. Because the last thing we want to do is have somebody pay for a study and not save significant tax dollars. So that's why we always provide a free analysis up front.
And that's why we work with you guys. Good company, honest people, right?
That's right.
All right. Thank you, Eric.
You're welcome. Thank you. It's been a pleasure.
All right.